Thanks for joining us for this month's market update, our first for 2022. I'm joined today by Chris Trevillyan, Director of Investment Strategy. Hi there, Chris.
Hi Wayne, Happy New Year.
And to you as well. So let's start off perhaps by having a look at what was impacting markets as we finished 2021.
Unfortunately, still COVID. So we saw the spread of the more contagious variant of Omicron and a big rise of new cases towards the end of the year. But perversely, given equity markets had sold off in November, they actually rebounded, produced strong returns for the month of December. The rationale for that was that the initial analytics were showing that the new Omicron variant was less severe than the previous Delta variant. And one of the earlier countries that have been impacted, South Africa, by the end of the month was already showing a decline in the number of new cases. However, given the scale of the new cases that we are seeing, hospitalisation rates are rising, and unfortunately the number of deaths is rising in a number of countries. And given the amount of people that have been infected, it is starting to impact on the availability of labour workforce. So although the hope is that this is a relatively short spike, it is extremely disruptive.
Indeed. And another really significant theme that's been occupying attention, particularly in the US, is inflation.
Yes, in the US, the Consumer Price Index, or CPI, recorded a 7% growth over the last 12 months. Haven't seen that sort of level since the early 1980s. It has been impacted by goods, particularly things like motor vehicles, fuel prices, transportation services, but even excluding for some of these more volatile items, the core inflation level has picked up markedly. Now, there's a number of drivers to that. One is a big rebound in demand as economies reopen after pandemic restrictions. There are supply chain constraints, although perhaps there's signs that those are starting to peak based on some survey results and some analytics of ships at seaports. And then the labour market is particularly tight. So we're seeing very high levels of job openings, but labour mobility, job participation rates are still not back at those pre-pandemic levels. So it seems that the inflation pressures are likely to remain for a little time further yet.
So what's been the response, Chris, from central banks and policymakers?
So central banks are now switching towards monetary policy tightening. So that involves quantitative easing or QE tapering, and in some cases, interest rates have already started to rise. So we've seen the central banks of the UK, Norway, New Zealand, South Korea have all raised interest rates. The US Federal Reserve at their December meeting, they announced that they would be slowing their bond purchase program, and they indicated that they would start raising interest rates earlier than they had previously indicated. And perhaps most noteworthy, the US Federal Reserve Chairman, Jerome Powell, made the comment that he thought it was time now to retire the word transitory when describing inflation. So I think that does give a clear indication of central banks' shift in their view of the inflation outlook, and that's going to have a big impact on investment markets in the year ahead.
All right, so as we start off in 2022, it's probably worthwhile just reflecting on how we finished the year. So perhaps could you just quickly run through your review of 2021 across some of the asset classes.
So this fairly simple chart is a summary of returns over the calendar year for equities, bonds, and cash. As you can see, the big rebound or continued rebound in growth assets that we've seen, and very strong returns there. So the bars on the left-hand side for equities, global equities returned around 25% over the calendar year, Australian equities nearly 20%. So that's as the economy continued its rebound from some of those pandemic restrictions. An exception is emerging market equities, and particularly Chinese equities produced a negative return over the year. So the Chinese economy, and in particular the property construction sector, did experience a pretty marked slowdown over the year. But we also saw some regulatory actions impact on some particularly internet stocks. So companies like Alibaba, Tencent, they saw their stock prices drop significantly over the year. At the other end of the chart on the right-hand side, as we've discussed, inflation has been increasing, and so the shift in focus over the year was towards monetary policy tightening. Now, monetary policy still remains very supportive at the moment, but the market is looking ahead to what's likely to occur in the year ahead. And so over 2021, we saw bond yields rise, and that meant bonds produced negative returns over the year. And then in the middle, we have cash providing that 0% return. The other factor that's not shown on this chart is foreign currency. Unhedged foreign currency exposure in aggregate produced a positive return for Australian dollar investors over the year. So with the US Federal Reserve expected to raise rates earlier, the US dollar appreciated, and we also saw the British pound appreciate against the Australian dollar as at the start of the year, the Brexit was finalised. So in summary, a big disparity between very large returns from equities and negative returns from bonds over the calendar year.
Thanks for that review, Chris. Plenty to watch, some big themes coming ahead. We look forward to you continuing to update us on those. And thanks to you for watching this month's Market Update.